Somewhere in America right now, a restaurant owner is loading a flatbed cart at Restaurant Depot, running short on chicken 20 minutes before the lunch rush. She doesn't know Kevin Huracan. She's never read a merger agreement. But in March 2026, Huracan spent $29 billion on her panic. By the end of this video, you'll understand exactly what he was buying, why Wall Street immediately said no, and why the most important twist involves a government decision from 11 years ago that makes the whole thing feel like something Huracan has been waiting to do for a very long time. The last part? It changes how you see every restaurant you've ever eaten at. So settle in. Here's the story. On March 30th, 2026, Sysco, the largest food distributor in America, announced a definitive agreement to acquire Sysco Restaurant Depot for roughly $29.1 billion. $21.6 billion in cash, another 91.5 million shares of Sysco stock. The boards had already approved it. The deal was real. If you've never heard of Restaurant Depot, that's kind of the point. It's not trying to be famous. It's 166 warehouse stores across 35 states. Concrete floors, fluorescent lights, steel shelves stacked with 50-pound bags of flour and 40-pound boxes of chicken thighs. Forklifts in the aisles. No music, no marketing, no delivery. You drive there, load a flatbed, pay, and leave. The customers are wearing chef coats still damp from morning prep. They're not browsing, they're working. Restaurant Depot was founded in Brooklyn in 1976 by Nathan Kirsch. It never went public, it barely made the news, and yet it quietly became the largest cash-and-carry food wholesaler in America. Profitable for 30 consecutive years, with revenue growing in 28 of those 30 years. $16 billion in revenue in 2025. Nearly $2 billion in EBITDA. $1.9 billion in free cash flow. More than 725,000 customers. And 55% of all U.S. independent restaurants sit within a 30-minute drive of one of its stores. That's what Huracan bought. Not a distressed asset, not a turnaround. A quiet, grinding, cash-generating machine that most Americans have never heard of, because it operates in the background of the background. His argument for buying it is elegant. Sysco's model is planned. Orders come in. Routes get optimized, trucks leave before dawn. A restaurant gets its Tuesday delivery, checks it in, and the driver moves on. That system works beautifully, until reality breaks the plan. Until a large party shows up Friday night and the kitchen runs short on chicken. Until the emergency. Huracan called it covering all purchase occasions. Delivery plus cash and carry. The weekly scheduled order plus the Saturday panic run. The numbers he pitched investors aren't small. The deal would boost Sysco's pro forma revenue by roughly 20%, EBITDA by 45%, and free cash flow by 55%. $250 million in annual cost synergies within 3 years. Plus, Restaurant Depot owns more than 80% of its physical locations. Large format warehouses near major metro areas, acquired decades ago when urban industrial real estate was cheap. That footprint is almost impossible to replicate today. Huracan didn't just buy a wholesaler, he bought locations nobody can build from scratch. Now here's where it gets complicated. When Sysco announced the deal, its stock dropped more than 13% by end of day. Shares that closed at $81.80 on Friday were trading around $71 by Monday's close. Wall Street looked at $29.1 billion in a pressured operating environment and said, "We're not sure." Their hesitation has a specific number attached to it. Post-close leverage projected at 4.5 times EBITDA. In a thin-margin, freight-sensitive, inflation-exposed business, that number matters. Buybacks get paused. The dividend gets protected. Huracan promises to de-lever by at least one full turn within 24 months. But the math only works if everything goes roughly right. The operating environment isn't exactly calm. In Sysco's second quarter fiscal 2026 earnings, reported just 2 months before the announcement, the company flagged decelerating restaurant foot traffic, product cost inflation running at 2.9%, driven by meat and seafood, and US local volume growth of only 1.2%. That's the moment Huracan chose to make his biggest bet. He'd argue that's exactly the right moment. He told investors directly, the cash and carry channel tends to take share in economic downturns because it is the low-cost leader. Restaurant Depot sells products at roughly 20% below what traditional distributors charge, because the customer handles the last mile themselves. When operators get squeezed, when consumers trade down, when restaurants need to cut costs anywhere they can, they drive to Restaurant Depot more, not less. Huracan is betting that hardship is a commercial tailwind for the channel he just bought. That's either contrarian genius, or it's exactly the kind of logic that sounds brilliant right up until 4.5 times leverage meets a recession. If you're finding this useful, hit subscribe. I drop videos like this every week. The best part of this story is still coming. Remember how I said this deal has a twist from 11 years ago? Here it is. In February 2015, the Federal Trade Commission filed to block Sysco's proposed merger with US Foods. The FTC's argument was stark. The combined company would control 75% of the national market for broadline food service distribution. It would, the FTC said, likely result in higher prices and diminished service for restaurants, hospitals, hotels, and schools, harming competition in 32 local markets. Sysco abandoned the deal that June. A $1 billion breakup fee changed hands. The government won. Here's the irony that should make you stop. During that 2015 antitrust fight, lawyers and regulators debated the competitive landscape, specifically whether operators had meaningful alternatives to Sysco. One question on the table: did cash and carry retailers like Restaurant Depot constrain Sysco's pricing power? Did their existence serve as a check on how much Sysco could charge? The company once cited as evidence that Sysco couldn't dominate the market is now a division of Sysco. The competitive check became part of the machine. The escape valve got absorbed. And Huracan is doing it while telling every independent restaurant owner in America it's going to make their lives better. More affordable options, more access, more choice. A Wells Fargo analyst called it an attractive deal, adding exposure to underserved customers. Huracan himself said there are zero revenue synergies built into the model beyond new store openings, a surprisingly conservative stance that either signals real financial discipline or suggests the obvious upside isn't as obvious as it looks. Both things can be true at the same time. That's what makes this a genuine tension rather than a simple villain story. The small restaurant owner might genuinely benefit from lower prices and more locations. She might also lose the one independent alternative that kept her larger vendor honest on price. The small supplier might get more volume commitments, or get squeezed by a buyer with $97 billion in combined revenue sitting across the table. The warehouse worker hears, operates separately, and hopes it holds. They've heard synergies before. Deal close is expected by Sysco's fiscal third quarter of 2027. Regulators are reviewing it now. The ghost of 2015 is in every room where this gets decided. So there it is, the $29 billion question Huracan is asking the food system to answer. Whether he's future-proofing the supply chain or loading it with debt while quietly closing the last independent door for small operators. That verdict won't come from Wall Street. It'll come from the restaurant owner loading a flatbed cart, the supplier renegotiating terms they can't refuse, and the regulator deciding whether a different door is still the same room. Now you know what to watch for. Share this with someone who eats at independent restaurants, which is everyone, and subscribe so you don't miss what happens next.